So you've decided you want to get started with this whole investing thing, and you have realized that leaving your money rotting in a bank account or stuffed under your mattress isn't actually the safest thing for it. Actually, you would be better spending it now than hanging on to it and spending it later. Now you might be asking, Riley, what can I do to fix this? Well, you might have come to the right place, because this is the ultimate investor's guide for beginners in Australia. This video is going to be broken up into 4 parts, which will all be timestamped down below, so you can skip around when you want to. Part 1 is going to be why we invest and why we don't just save it. Part 2 is going to be some frequently asked questions and some common concerns about investing that people have. Part 3 is going to be the basics of investing and what to do about it. And part 4 explains a few common options of what to invest your money in. So let's move on to part 1, why we invest. And there are 2 main reasons that I want to present to you today. Number 1 is the one that we've all heard about before, inflation. You might think that that cash sitting in your bank account is safe, but inflation is eating away at that money value every day. I got an example for you. Say you had $50 today. $50 could comfortably get you an entree, a main, and a drink to go with it at a local pub. But in 10 years, that same $50 might only just buy you the meal, and you're gonna have to fork out some extra cash to get that drink and that entree. This same principle of inflation is applied not just to the food industry, but to all industries. Everywhere you can spend your money, prices are gonna go up because the price to do things is gonna go up. And the second reason, investing lets your money work for you. People are always dreaming about retiring early and having true passive income coming in while you're sleeping. For those people, if they want their dream to be realized, they need to learn about investing, because investing that money is what actually makes your money work for you in your sleep. And that extra money you made can make you more money on top of that. So that extra money can be reinvested and make you more money, which will then in turn make you more money. This basic principle is called compounding, and you can see that it turns into this vicious cycle, which is a good thing when you start to get a little bit of momentum. It's just like a snowball rolling down a hill. As it gathers momentum and picks up more snow, it just gets bigger and bigger and bigger. And this is why Einstein has coined saying compounding is the 8th wonder of the world. So the general idea here is that banks are for safety and emergency funds, and investing is for growth and for wealth. And once we already have that safety net in place, we want to aim for a little bit of that growth and wealth. And that brings me to part 2 of this video, some frequently asked questions and common concerns about investing. Question number 1 that I mainly see is, how do I even start? Do I just go to the Tesla website and click the invest my money button and I'm off to the races? In an ideal world, that would be awesome, but in today's world, you need a bit of a middleman, and that's something called a brokerage account. The average person like you and me, we need to go through a brokerage account, and that typically manifests in the form of an app on your phone. This is going to differ from country to country, but do a little bit of research, just a simple Google search about what brokerage apps are available to you and what most closely aligns with what you want to do with your money. Something to keep an eye on is just the fees. Some brokers charge a percent of how much you invest each transaction, and some charge a flat rate. It all comes down to just how much you're going to be investing and how often, and finding a brokerage account that works best for you. I personally use the app Stake, a brokerage account that's available to us here in Australia. It gives you access to all the Australian markets and all the markets overseas. I'm not sponsored or anything, but if you want to sign up to Stake, the same brokerage app that I use, I do have a code. It'll be up on the screen here and also in the link down in the description. Using this code just gets you a free stock when you sign up instantly, just to give you a little boost to your investment portfolio straight away. So if you're going to sign up to Stake, you may as well plug it in. If you're lucky, you could pull a free stock like a stock in Nike, which is worth up to 100 Australian dollars. So kickstart your investment journey today. The next question is, how much do I even need to start? And the simple answer to that is you only need a couple of dollars. $5 to $10 is enough. The key to investing is to build the habit as early as you can and to start as early as you can, because small amounts invested consistently over time can grow massively thanks to compounding. What matters is just taking the plunge and getting started now, rather than waiting until you feel like you're ready. Stake, like many other brokerage apps, allows you to buy fractional shares, meaning you don't have to buy the full share, which can be a couple of $100 just to start investing. Instead, you can just start with $10 and buy a small percentage of that share and therefore have part ownership in that company. And then you can get that snowball rolling down that hill. The third question is, isn't it too risky? Am I going to lose all my money? Risk is a part of investing, I will say that. But what needs to be remembered is that doing nothing with your money, that comes with risk too. There are some very safe ways to start investing. All things you can find out either on this YouTube channel or others, or even a quick Google search. It really just depends on what risk level you are comfortable with. Some people are willing to risk it all to hopefully triple X their money overnight. And some people like me prefer a more medium to conservative approach and are happy to watch their balance grow safely over time. And the fourth question is, when is the best time to start investing? And to that, I tell all my friends, the best time to start investing was yesterday, but the second best time is today. The earlier you can get your money compounding, the better, because that money earns you some more money, and then it gets reinvested, and then it earns you more money, which will earn you more money again. If you're enjoying the video so far, I just want to ask a massive favor. Smash that like button down the bottom for the YouTube algorithm. It really will help my channel. Moving on to part 2 of the video, and that is the basics of investing and the general philosophy behind it. So in really, really simple terms, at its core, investing is you buy something and that thing makes you more money over time. It could be a lot of things. It could be shares in a company. It could be a rental property. It could be even investing into your own skills. But the essence of it is always the same. You're spending more money to make more money. Just think you always want your money working for you instead of you always working for your money. Now, the big first principle is risk versus reward. Usually the higher earning potential on an asset that you buy also correlates to a much higher risk. Think about this. Putting your money into a bank account is very, very safe, but it barely grows at all. On the other hand, investing into a brand new crypto coin could double your money overnight, but the coin could also crash and you could lose everything. The sweet spot for most people is finding an investment that is likely to grow over time and not so likely to lose any money. Because what actually causes you to lose money when you're investing is your emotion around it. If you bought some stocks in the market before the famous 2008 market crash, you probably would have seen your brokerage account lose thousands and thousands of dollars over a few months. But what happens is people get scared, people get sad, and they think, oh, I've lost all this money, quickly sell it all before I lose any more. What the issue with that is that actually brings that loss into realization. But instead, if you just held on and stuck to your guns and waited till the market recovered, you wouldn't have lost any money and you actually might have made some gains. Realistically, the best way to invest is just to find your risk tolerance and invest into something that aligns with that. The second principle I've already talked a little bit about, but it is the power of compounding. And it's my favorite principle, so I'm happy to re-mention it. It's like a snowball that starts off this big that you push down a hill. It starts small, but the longer and further it rolls, the bigger and bigger it gets. Let's say you invest $100 and it grows by 10%. Now you have $110. If the next day it grows another 10%, you don't just earn extra on the original $100 that you invested. You also earn extra on the $10 that you earned the previous day. So the next day you've earned $11 and your total comes to 121. Over years and years, this tiny snowball can grow bigger and bigger into something massive. And eventually the growth of your snowball or your portfolio will be something that you never imagined. And that's why starting early is so powerful. The third principle is diversification. Just like the saying goes, don't put all your eggs into one basket, because if that farmer drops the basket, all the eggs crack, you lose everything. Imagine you save up your hard-earned cash and you open a cafe and it's your only source of income. But then something happens to that cafe and you guys have to shut down and you lose everything and your income grinds to a halt. Instead, diversify your money. Put some money into shares, put some money into property, maybe put some money into your own business like that cafe. Then if one area struggles, the other areas can still carry you. Diversification protects you from being wiped out on one bad bet and is the reason why investing can actually be really, really safe. The fourth principle is having a long-term mindset. If you have the mindset that you want to get rich overnight and you start putting your money down into risky places with the promise that you could double your money, the likelihood of that actually happening is quite small and the likelihood of you actually losing all your money is quite large. And just like the emotional investing that I talked about before, how it's a bad thing, you have to remember that the market is always going to fluctuate. The market goes up and down overnight in the short term, and people can easily get caught out worrying about it too much and selling when they shouldn't have. If you're looking at the market fluctuations and you're getting stressed yourself, the best thing to always do is to zoom out. If you zoom out to 5 years, 10 years, 20 years, you can see that all of those bumps that you were worried about before zoom out and they're just little grains of sand in perspective. History has always showed us that the patient investors win and the impatient emotional investors tend to lose money. So think of investing like you're planting a tree. You don't plant it today and expect to get shade tomorrow. You plant it, you water it, you protect it, and eventually it grows into something over time that's tall and provides more than you have to put into it. That's the basics and philosophy behind investing. Start early, be consistent, spread your risk out, and think the long term. All right, so now let's talk about what you can actually invest in. There are a lot of options out there, and each one comes with its own pros and cons. So let's break down a few of the more common and popular options. And first up is the bread and butter of investing, stocks and shares. When you buy a stock of a company, you are literally buying part ownership in that company. And if the company grows and makes more money, that benefits you too. Over the long term, the stock market has historically given very strong returns. The tricky part is picking which companies to invest in. There's thousands of companies out there. How are we supposed to know which company to choose? And it sounds real risky because what if you're wrong? What if the company goes bust? And what if you lose all your money? That's why a majority of investors just stick with ETFs, which are basically big baskets full of multiple different individual stocks. Instead of betting on one company, you're diversifying, spreading out your risk, and betting on multiple companies with small amounts of money. So then if one company goes bust, you've only lost a few dollars, and the other companies who are still alive and well can keep you going strong. I break down what ETFs I invest in every single month in my net worth updates, so go and check that out on my channel. But investing into ETFs are going to be your safest bet if you want to get started in stocks and shares. Then we've got crypto. This one's a little bit different. It's high volatility, it's high risk, and it can sometimes be very high reward. The price can shoot right up and crash all in one day. So the rule that I follow when I invest in crypto is only invest what you can afford to lose and will be comfortable losing. An argument can be made that investing into crypto helps your diversification, especially if you already have all your money in stocks and shares, but it's usually not recommended as your main investment. I like to think of this one as a small slice of my portfolio, not the whole pie. Next up is real estate, and it's one that my wife and I have seen good success in. It's more traditional, people feel more comfortable with it because you can actually see it and you can actually touch it and you can live in it. Property has built a lot of wealth for people because it is tangible and it grows in value over time. You can use it to generate things like rental income, and you can see capital growth on your properties, and this can all be leveraged through bank loans. The downside is that you need a lot more money up front to get started in real estate, and it's not usually a realistic option for people who are only just getting started in their investing journey. And where I see a lot of people fall short in their portfolios is having all of their money invested into real estate and not diversifying into different things. Therefore, putting all of their eggs into the one basket of real estate and just riding or dying with this market. So if you're not quite there with your first house deposit, investing into ETFs and a little bit into crypto is a great place to start. And remember, with all types of investing, it's about getting into the market and getting that snowball rolling. So that might be a better option for you now currently. Now, I will mention that some people are quite attracted to fast lane investing. These are things like startups, angel investing, business flipping, day trading, and futures. These do have very high potentials to make you quite a lot of money in a very short amount of time, but equally they also come with a very high chance to lose a lot of your money very, very quickly. It's fast, it's exciting, and some people have seen great success in doing this sort of thing. But remember, do all of your research and talk to a financial advisor before you do anything. And now is a good time to remind you that I am not a financial advisor and this is not financial advice. So before taking any actions in your financial journey, make sure you talk to someone who is licensed and can take your whole situation into account. And finally, maybe the most important one is to invest in yourself and to do it early. This could mean taking a course, getting a certification, even learning that new skill that makes you more valuable in your career. It can also mean using a little bit of money to start up a side hustle or to start that business that you've been dreaming about. The return on investing in yourself is often the highest, especially if you do it when you were young, because those skills that you learn doing that course or starting that business can continue to pay you back for the rest of your life. Take, for example, Alex. She is working as an orderly at her local hospital. She's working 40 hours per week and she's earning $2,700 per fortnight. Alex then went to TAFE. She got in on the fee-free program that they often offer to people, and she she ended up getting her Certificate 3 in Health Services Assistance. Alex now can be employed at this very same hospital as an assistant in nursing. She's working the same 40 hours per week, but instead she's getting paid $3,000 per fortnight. As you can see, Alex has increased her income by an extra $300 per fortnight. And the earlier you do this sort of thing, the earlier that this income increase comes, and therefore the more money you will have ready when an investment opportunity arises. So to sum it all up, ETFs are a great basic and easy way to get started. Crypto is a little bit of a high risk area, but it can pay off sometimes. Real estate builds long-term wealth. Fast lane investing is for the brave and also for the very well informed. And investing in yourself is something that everyone should be doing, even from a young age. The best portfolio usually has a mix of all of these things, and the right mix depends on your goals and also depends on the level of risk that you are comfortable with. Always take into account where you are in life and never shy away from seeking a little bit of advice before you do anything. Remember, investing is about time in the market, never about timing the market. The earlier you start, the better. And that principle applies to everything, including investing in yourself. So if you found this helpful, please chuck me a like for the YouTube algorithm and hit subscribe down the bottom for more beginner-friendly investing tips, especially if you want stuff that is more specific to Australia. And let me know in the comments, what's the first investment you want us to get started with in 2025 to get yourself into the market and to get that snowball rolling. Guys, if you enjoyed that video and want to see what I'm doing with my investing, click here and I'll break it all down for you guys. Wait, you're still here? Click it. Come on.